Hey everyone, and welcome back. Today we're doing a deep dive with a legend, Peter Lynch.
And we're going old school with this one.
Yeah, like way back. This is a lecture from 1997.
Before the dot-com bubble.
Before social media even.
Before most people were even using the internet.
Exactly. But here's the thing.
His insights are just as relevant today. Maybe even more so.
I think so too. We've got some great notes from this lecture. We're going to break it down.
Actionable advice. You can use it right now to become a better investor.
You know, I think a lot of people get intimidated by investing. Like it's all, complex algorithms.
Wall Street jargon.
Yeah. But Lynch's approach, it's refreshingly straightforward.
Absolutely. He cuts through the noise, focuses on common sense, empowering the everyday investor.
And one of the first things he talks about is knowing what you own.
Super important.
So let's unpack that. What does he mean by knowing what you own?
Okay, so he gives this hilarious example. A tech company's description, full of jargon, megabits and gigahertz.
Yeah, I could see that.
And he asks, if you saw that company's stock price drop, would you know what to do? Most people wouldn't.
So, don't invest in things you don't understand.
Exactly.
It's easier to make decisions when you get it.
Right. And he compares this to, say, Dunkin' Donuts.
Okay, sure. Everyone knows Dunkin' Donuts.
Yeah, you see their stores, you know what they sell, you know what they do. If you can't explain a business model to a kid, probably shouldn't be investing in it.
Such a simple but powerful way to think about it.
Yeah, it really is.
So how can our listener actually apply this? What questions should they be asking when researching a company?
Great question. Start with the basics. What does the company do?
What are they selling? Who are their customers?
Exactly. How do they actually make money? Then you can go a bit deeper. Competitors.
Strengths and weaknesses. Risks and opportunities.
You got it.
So it's more than just a brand name.
Yeah, you really got to understand how the business operates.
The nuts and bolts.
Precisely. And here's a little secret. You don't need a finance degree to do this. Look around you. Think about the companies you interact with every day, the stores you shop at, the websites you use.
The products you love.
Exactly. Could one of them be your next investment?
That's a great point. It's easy to get caught up in the hype. Some hot new stock.
Yeah, but those aren't always the best opportunities.
Sometimes the best ones are right in front of us.
Absolutely. Now, another key point from Lynch. Trying to predict the market. Complete waste of time.
He actually says that if you spend 13 minutes a year on economics, you've wasted 10 minutes.
He's got a point.
Yeah, he's not saying economics is unimportant. He's saying don't get caught up trying to time the market.
Yeah. Don't try to predict interest rate changes.
Or the next big economic event.
You'll drive yourself crazy, and you'll probably be wrong anyway.
You know, he's got decades of experience to back this up. He's seen it all. Recessions, market crashes.
Everything.
And his conclusion, focusing on individual companies.
Way more productive.
Than trying to predict macroeconomic trends.
Exactly. He'd rather dig into a company's inventory levels.
Sales trends and debt.
Then listen to economists speculate about the future.
He wants to see the facts on the ground.
Always.
So what should our listener be focusing on instead of these market predictions?
Focus on understanding the businesses. The ones you're investing in. Does the company have a strong track record? Are they profitable?
Are they growing their sales, their market share?
Yes. Do they have a solid balance sheet? These are the kinds of questions that will help you identify winning investment.
It's about looking at the company's performance, not getting distracted by all that noise.
All that noise in the market.
Right. And Lynch reminds us, time is on our side.
Absolutely.
As investors, we don't have to catch a stock on day one to make incredible returns.
You really don't.
He uses Walmart as an example. He points out you could have bought Walmart 10 years after it went public.
And still made 30 times your money.
30 times.
30 times. Good companies can grow consistently for decades.
It's not about chasing the next hot stock tip.
No. It's about finding solid businesses, letting them do their thing over the long haul.
So we've talked about knowing your companies and being patient. But Lynch also warns us about some common traps. These are the traps that investors fall into.
Yeah, he calls them the 10 most dangerous things people say about stocks.
I gotta admit, I've definitely fallen for some of these myself.
Oh, they sound so convincing, almost like common sense.
Yeah.
But then you break them down, you realize, wait a minute.
How flawed the logic is? Let's start with this one. If it's gone down this much already, it can't go any lower.
Right. Lynch debunks this with Polaroid.
Polaroid, okay.
The stock went from $140 down to $107, and everyone thought it was a steal. But it
Wow.
kept falling.
Really?
Eventually hit $18.
Ouch. So just because a stock has dropped a lot.
Doesn't mean it can't fall further.
Right.
A stock price doesn't have a memory.
That's a good way to put it.
It doesn't know where it's been before.
Yeah.
What matters is the company's future.
He also talks about the flip side of that. Like, if it's gone this high already, how can it possibly go any higher?
Oh, yeah. He uses Philip Morris for this one.
Philip Morris.
It sold for 12 cents back in 1951. By 1961, it was already up fivefold. People thought it had peaked, missed out on it becoming a 100-bagger.
A 100-bagger?
A 100-bagger, yeah. That means it multiplied in value 100 times over.
Wow.
Incredible growth stories can play out over long periods. We get anchored to what we've seen.
Right.
And we just assume the growth has to slow down at some point. But sometimes,
Wrong.
totally wrong.
Okay, so it's not just about the big names, though.
Oh, absolutely not. Lynch tells the story about Taco Bell.
Okay, Taco Bell.
They had no debt. They were making decent profits. But guess what? The stock went from $14 to $1 in 1974.
So even seemingly solid companies.
Can experience huge declines.
Yeah. What's the takeaway here for our listener?
Don't make assumptions, about how high or low a stock can go, just based on past performance.
So what? We should be digging deeper.
Yeah. Dig deeper into the company's financials. Look at their industry, their competitive landscape.
Do your research.
Exactly.
Okay, what's another one of these dangerous sayings?
Eventually, they always come back.
Yes. The hope that a fallen stock will magically return to its glory days.
But Lynch reminds us, not all stocks recover.
Okay, right.
Businesses change, industries evolve, and some companies, they just don't adapt. He mentions RCA, Manville, International Harvester, never bounced back.
So how do we avoid that trap? How can we tell if a struggling company actually has a chance?
You need to see concrete signs of improvement.
Like in their fundamentals.
Exactly.
Huh.
Are they addressing their problems? Are they innovating? Are they adapting to the market? Is their management team strong?
It's not enough to just hope for a rebound. You need to see evidence that the company is actually on the right track.
Exactly. Okay, here's another dangerous phrase. It's only $3 a share. How much can I lose?
A lot of people think that.
Right. A low share price equals low risk. But a $3 stock can go to zero just as easily as a $50 stock.
Right.
Lynch uses a simple example. Imagine investing $25,000 in a $3 stock. If it goes to zero, you lose everything. Doesn't matter what the share price was.
So it's the total amount you're putting at risk, not just the per share price.
Exactly. And here's another track. If it rebounds to what I paid for it, I'll sell.
Oh, so many people do this, waiting to break even.
Erase the loss. But the stock doesn't know you own it.
Right.
It doesn't care what you bought it at. Holding on just to break even could mean missing out on better opportunities.
So what should we do instead?
Evaluate your investments based on their future potential, not past losses. Has the company's story changed? Are there more promising investments? It might be time to move on, even if you haven't fully recovered.
Okay, I'm starting to see a theme here. Lynch is all about looking forward, not dwelling on the past.
He is. He's also warning against getting complacent, certain stocks, just because they're considered conservative.
Like blue chip companies.
Exactly. But even those can experience big declines. He mentions Eastman Kodak, IBM.
Okay, yeah, those are big names.
Both fell 75% at different points in their history.
Wow. Not exactly what you'd expect from conservative investments. So how do we assess risk? If even the so-called safe bets can tank.
It all comes back to understanding the business. Don't rely on labels or past performance.
Right.
Do your own research. And remember, no investment is truly risk-free.
That's a good reminder.
Huh.
Okay, what else does Lynch warn us about?
This one is a mental trap. Look at all the money I lost by not buying it. He says people fixate on the stocks they missed out on, especially the big winners.
Oh, yeah, totally. It's like watching your neighbor win the lottery. Makes you question everything.
Right. But you can't lose money on a stock you don't own. Focus on the investments you do have.
Make sure they're still aligned with your goals.
Exactly. And another related trap, believing that if a stock is going up, you must be right. And if it's going down, you must be wrong.
Oh, I see this all the time. People getting caught up in those short-term price movements.
Yeah, they think a rising stock price validates their decision, even if the fundamentals haven't changed.
That's emotional decision-making.
Can be dangerous.
Yeah.
Remember, stock prices fluctuate all the time. A short-term gain doesn't mean you're a genius, and a short-term loss doesn't mean you're a fool.
So we need to separate our emotions from our investment decisions.
Exactly. Stick to your strategy. and focus on the long term.
Okay, so we've covered a lot of ground here, knowing our companies, being patient, avoiding those dangerous investing myths. But Lynch also talks about these long shot companies, the ones with the exciting stories, but no real sales yet.
Yeah, he calls them whisper stocks. You know, the kind that make you think, like, if this works, this is going to be huge.
Yeah.
But Lynch has a different name for them.
What's that?
No shots.
No shots. So he's saying don't fall for the hype.
Right. If a company doesn't have any sales, it's a gamble, not an investment. It's like betting on a horse race without knowing anything about the horses.
So how do we find those solid companies, the ones with the real potential?
You don't need to hit home runs to be successful. Lynch points out that he made 20 or 30 times his money on stocks he never thought would be huge winners. Companies like Fannie Mae.
Fannie Mae.
Or Stop and Shop.
Those are companies everyone knows.
Exactly. It's about finding those steady growers and letting them compound over time. Of course, management is important
Right.
to a company's success, but Lynch says it's really hard for an outsider to truly assess management quality.
So we can't always tell the difference between great management and good management.
Just from a few presentations, right, he emphasizes that we should focus on companies with solid business models and clear paths for growth, even if we're not totally blown away by the management team.
He actually says he likes companies that any fool can run because eventually one will.
He does. It reminds us to focus on the business itself, not just the people running it.
Something else Lynch talks about is the importance of being flexible as an investor.
Yes. Don't limit yourself to certain industries or get stuck in preconceived notions about what makes a good investment.
He criticizes those rigid buy lists some institutions use.
Oh, yeah.
He says we should be constantly researching and evaluating new opportunities.
Keep an open mind.
Right.
And let the story of the company guide your decisions. What's the narrative driving this business? Are the fundamentals strong crack? Do you see a clear path for future growth?
He's a big believer in understanding the story.
Uh-huh.
And I think this is where some people get intimidated.
Sure.
They think investing requires, a fancy math degree.
Right.
But Lynch debunks that myth too.
He tells a hilarious story about his roommate in the Army
Okay.
who struggled with the concept of X in algebra.
Algebra, yeah.
Lynch's point is you don't need to be a math whiz to be a good investor.
He says if you can add 8 and 8 and get pretty close to 16, you have all the math skills you need.
He does. It's about understanding the basics of a business, not complex formulas or algorithms.
That's so refreshing to hear in a world where, we're constantly bombarded with data.
And financial jargon,
Yeah.
right?
But perhaps the most important message Lynch delivers is that there will always be something to worry about.
Oh.
Always.
In the market.
Always something.
The economy, interest rates, world events.
The list goes on and on.
It goes on.
He recounts decades of market anxieties, from the Cold War to the oil crisis to the rise of Japan. He says getting caught up in fear will cause you to miss out on opportunities.
He reminds us that market downturns are inevitable, but they're temporary.
Absolutely.
The key is having that discipline, to stay focused on the long term.
Yeah.
He jokes that he knew the market was going to crash in October 1987
Because
he finally decided to take his first vacation in 6 years.
Oh, no.
He was in Ireland enjoying himself when the market tanked.
Of course, that's how it works.
That's a great story. So what does all this mean for our listener? What are the key takeaways, that they can use right now?
First, remember that investing is about understanding businesses, not just following stock prices. Find companies you believe in, do your research, and be patient.
Second, tune out the noise.
Don't try to time the market or get caught up in the short-term fluctuations.
Stay focused on the long game.
Exactly. Third, be aware of your own psychology.
Yes,
Fear and greed can lead to really bad decisions.
for sure.
Have a plan and stick to it,
Yeah.
even when the market is volatile.
Especially when the market is volatile.
This has been such an insightful deep dive, into Peter Lynch's wisdom.
It really has.
It's a great reminder that investing can be simple and accessible to everyone.
It really can be.
He encourages us to be curious, to think for ourselves.
And to challenge conventional wisdom.
Absolutely.
Mm-hmm.
So as you go about your day, think about the companies you interact with,
Yeah.
the products and services that you love. Could one of them be your next investment?
Sometimes the best opportunities are right under our noses. Happy investing every one of your